In December, the Reserve Bank of Australia kept interest rates at 1.5%, and debt futures imply scant chance of any cut in rates this year. The latest Australian data show the trade balance swung to a surplus of 1.2 billion Australian dollars, calming fears of an Australian recession. Meanwhile, in Tokyo, the Bank of Japan has turned optimistic on the growth outlook in Japan there, with rising domestic demand, large-scale fiscal stimulus and growing exports. Michael Boutros is a currency strategist at Daily FX and is looking at the Aussie yen. Michael, what's interesting about this trade at the moment?
Sure. So from a fundamental standpoint, let me start off by saying we got 2 interest rate cuts from the RBA last year. And so in my opinion, heading into 2017, it's unlikely we'll see the central bank move for additional easing. In fact, if you look at overnight index swaps heading into November, December, even as early as October of this year, we are actually looking for a higher percentage or likelihood for an interest rate hike from the RBA. So I don't think monetary policy outlook will necessarily be a burden on the Aussie moving forward in the latter half of 2017. As it pertains to the BOJ, look, it's all going to be about that yield control that they're undergoing and whether they're going to be able to really effectively start to stoke inflation to that 2% inflation target. It's something we've been struggling with all year, right? Is the BOJ going to ease further or not? It's something they will have to see how that impacts the asset purchases. The real merits of Aussie yen come from the technical standpoint. So here's the chart that we've been following and that we posted on this year's 2017 outlook. Obviously, heading into the start of 2016, we noted a downside bias while within the confines of this large, broad, descending median line formation off the highs from 2013 and 2014. Key support in an area of interest for long exposure was down at 72.15 into 74.22. It's exactly where the low was registered this year. With the break that we made here in Q4, specifically November, really shifting the bias here for Aussie yen back to the top side. So heading into the 2017 calendar year, you're going to want to maintain that upside bias while within the confines of this formation, with a breach above this near-term resistance really needed to get this thing going heading deeper into the year.
So what's your target then for Aussie yen, and over what time frame?
So as far as the targets and the time frame for Aussie yen, early in the year, first quarter, you should be on the lookout for some weakness here in the pair. Again, checking out the technical levels, you're holding just above the 50 line here for the current ascending median line formation off last year's low. The reversal that we made was off key resistance. Bring your attention to 87.64 into 87.55. That's the exact 2016 yearly open. The 50% retracement of the decline off the highs that we made in 2014, and both of those levels converge right on the median line, extending off last year's lows. So certainly as far as near-term resistance, very well-defined region. Again, heading deeper into Q1, I do think you look for a new low here. Key support, or near-term support, I should say, 81.50 into 82, essentially, 81.97 is going to represent the lows that you made back here in 2015. Also, the swing high that you made back in June. Just below that, key support and bullish invalidation level is going to be down at that 52-week moving average near 80.60, 80.70. Note that that region with that moving average also converges on the lower parallel and, more importantly, longer parallel support. This is a basic trendline resistance extending off the 2011 and 2012 highs. If you take a parallel extending off the 2013 highs, you can see that that literally caught the high for 2014. That same slope converges all down here with the 52-week moving average and current operative upslope support down at 80.60, 80.70. So again, a key region of support. As long as price holds that, we should be looking for dips into this region to offer fresh exposure on the long side. A breach through key resistance at 87.64 looks to target a critical resistance zone right here at 90.65 into 91.22. Again, the key 618 retracement of the decline off that 2014 highs and an exact 1618 extension from the ascent off last year's low. Both of those converge on the median line heading into the start of Q2. Later in the year, again, in the latter part of Q2, heading into early Q3, you're looking at a longer dated subsequent resistance target up into 96.33. Keep in mind a few things. We're working on the premise that this could be a large-scale bottoming process here in Aussie yen. I do want to bring your attention also to the fact that if we do break this after moving lower, we could be working with a near-term head and shoulders formation here, which certainly would shift the focus much more aggressively to the long side of Aussie yen.
Of course, one of the interesting things is this is seen as a risk barometer, the Aussie yen. So how should we read these moves on a wider scale?
So great question. One thing I would caveat by saying is this: there are certain times and certain environments where the Aussie yen is a great gauge for risk assets, or a basic risk barometer, as you put it. As it stands right now, I don't really think that's going to be your most effective gauge. It's really the yen that's going to be a much more sensitive currency to risk. And I think if you're looking as a broader risk for dynamic, or a barometer for risk, you're probably better off looking at dollar yen. If we take a look back at the charts for Aussie yen, we can quickly put on an overlay here just to compare what the S&P has looked like in comparison. And while near term, just over the last couple of months, yeah, I think it looks like the correlation may be tightening, keeping in mind that obviously this correlation is tightest, guys, as inflation rallies. When inflation is in a deflationary environment, typically you see this correlation break. So I do think we can see this correlation start to mount and become a little stronger this year, but as it stands right now, I still think you're better off looking at dollar yen. Some basic just things to keep in account. We made a fresh quick break and recovery below that 2014 low in the S&P. As far as price action is concerned, Aussie yen, we made a much more dramatic low. So on this ascent, is that correlation starting to tighten up? Maybe. I think, again, look at dollar yen for a better gauge of risk assets, and as the inflationary picture starts to improve, you're likely to see that correlation with broader risk assets and Aussie yen begin to tighten up a little more.
Okay, Michael, thanks very much indeed. Michael Boutros is a currency strategist at Daily FX, joining us there on camera from New York.